There are some deals on Wall Street that, at first glance, look like nothing more than a multi-billion-dollar transaction between two financial companies. But if you look a little closer, a deal like this can reveal a lot about how money is changing the way the U.S. market operates. And the deal I want to talk about today is Goldman Sachs' acquisition of NEOS for approximately $2.3 billion. If you own income-generating ETFs, especially funds that use covered call strategies, you may have already heard the news. But the real question isn't simply, how much did Goldman Sachs pay for NEOS? The more important questions are, why does Goldman Sachs want to own NEOS right now? And what could this deal tell us about the future of passive income, covered call ETFs, and the way Americans are building cash flow from their investment portfolios? I think that's the part worth sitting down and thinking about. Because after years of working with and studying the U.S. financial markets, I've noticed something pretty interesting. Major changes in the market don't always begin with a crisis. Sometimes they begin when large financial institutions recognize a trend that has been quietly developing before the majority of investors even notice it. And covered call ETFs could be one of those trends. Imagine that you've spent years building a stock portfolio. You own the S&P 500. You own the NASDAQ. Maybe you have some technology stocks and some blue chip companies. Over time, your portfolio may continue to grow in value. But then one day, you enter retirement. At that point, the question in your mind may change completely. You're no longer asking only, how much will my portfolio grow? You start asking, how much money can this portfolio generate for me every month? That is a major shift in investment thinking. When people are younger, many focus on growth. They want their assets to appreciate as quickly as possible. But as they enter the stage of actually using their wealth, especially in retirement, cash flow starts to become much more important. And that's where income ETFs enter the picture. Funds such as GPIX, GPIQ, SPYI, and QQQI use option strategies, with covered calls being an important component, in an attempt to turn a portion of market volatility into cash flow. But there's something I want you to pay especially close attention to here. There is no free lunch in the financial markets. A high-yield ETF does not automatically mean it is better than an ETF with a lower yield. If a fund is generating a very high distribution, you need to ask, where is that cash coming from? And more importantly, what am I giving up in order to generate that cash flow? That's one reason I believe the Goldman Sachs and NEOS deal deserves attention. Goldman Sachs is not a small company experimenting with a new idea. It is one of the largest and most influential financial institutions in the United States. When it spends approximately $2.3 billion to acquire NEOS, it isn't simply buying a name. It is acquiring an experienced team, a product platform, a brand, and, perhaps most importantly, a position in a growing market. And when you look at what's happening with the demand for income investing in the United States, the deal starts to make even more sense. The U.S. population is aging. More and more people are entering retirement. They have assets, but they also need to turn those assets into cash flow. Someone with a $500,000 investment portfolio may not care only about whether that account grows from $500,000 to $600,000. They may also care about how much money that portfolio can generate each month without forcing them to sell assets at exactly the wrong time, such as during a market downturn. That is a very real need. And when a real need becomes large enough, Wall Street pays attention. Goldman Sachs has paid attention. NEOS has built products around that need. And now these two forces are coming together. But the most interesting part is still ahead. Because if we focus only on the $2.3 billion price tag, we could miss the bigger story. This deal could be a sign that competition in the U.S. income ETF market is entering an entirely new phase. And to understand why that matters for your own portfolio, we need to take a closer look at something many investors overlook: total return. Because ultimately, the question isn't simply how much money you receive every month. The real question is, after all the distributions, price appreciation, and growth opportunities you may have given up, how much has your wealth actually grown? That's where the story of Goldman Sachs, NEOS, covered calls, and passive income becomes truly worth thinking about. Now let's take a deeper look at what's really happening behind Goldman Sachs's acquisition of NEOS. Because if you only look at the $2.3 billion price tag, you might think this is simply a corporate acquisition. But in the financial world, major deals often reflect something much bigger than the deal itself. And in this case, I believe Goldman Sachs is buying more than just NEOS. They're buying a position in the future of the income investing market. Think about it in a very practical way. Suppose you own a $500,000 house. You could simply hold on to the property and wait for it to appreciate. But if you want to generate additional income, you could rent out part of the property. A covered call is based on a somewhat similar idea, although the financial mechanics are much more complex. You own an asset, such as a portfolio of stocks. Instead of simply waiting for the stock price to rise, you use options to generate additional premium income. That premium can become a source of distributions for investors. Sounds very attractive. But this is exactly where we need to slow down. Because if there's one thing I want people searching for passive income to understand, it's this. High income does not always mean strong asset growth. This is one of the most common mistakes I see investors make. They look at one ETF and see a 10% yield. Then they look at another ETF with a yield of only 1.2%, and immediately they think the 10% ETF must be better. But investing isn't that simple. Suppose a fund is worth $100. Over the course of a year, it distributes $10 to you. That sounds great. But if, after those distributions, the value of the underlying investment falls or grows significantly more slowly than the broader market, then that $10 doesn't tell the whole story. That's why total return matters. Total return is essentially a way of looking at both sides of the equation. The income an investor receives and the change in the value of the investment itself. And that's also why I pay close attention to the differences between ETFs, such as GPIX, GPIQ, SPYI, and QQQI, and funds that are simply focused on maximizing distributions. During a strong bull market, covered calls can create a very interesting trade-off. You still own the underlying assets. You can still collect option premiums. You can still receive distributions. But if the market rises too quickly, the options you sold can limit some of the upside you would otherwise capture. In other words, you're giving up some potential upside in exchange for current income. And that's not necessarily a bad thing. It's simply a trade-off. This is where I think investors need to become more sophisticated in the way they evaluate ETFs. Don't just ask, what's the yield? Ask, how does this ETF generate that yield? That is a completely different question. If you're in your 30s and your primary goal is to maximize your wealth over the next 25 or 30 years, a strategy that is heavily focused on income may not align with your objectives. But if you're 60, 65, or 70, and you need a consistent source of cash flow to help cover your living expenses, the situation can be very different. That's exactly why the covered call ETF market is becoming increasingly attractive. Not because people have stopped wanting to build wealth, but because more and more people want to know how to actually use the wealth they've accumulated. And that is a very important shift. During the wealth accumulation phase, you might ask, how can I turn $100,000 into $500,000? But during the wealth distribution phase, the question becomes, how can I make $500,000 support my lifestyle for many years without forcing me to sell assets at an unfavorable time? Those are two completely different questions. And I think Goldman Sachs sees this shift. NEOS has experience building products designed to address that need. Goldman Sachs brings enormous scale, brand recognition, distribution capabilities, and resources. When those two things come together, they could become a very significant competitor in the income ETF market, especially when you look at GPIX and GPIQ. GPIX focuses on the S&P 500, while GPIQ focuses on the NASDAQ 100. What's interesting isn't just their distribution rates, but also their ability to pursue competitive total returns relative to traditional index ETFs during the periods discussed in the analysis. That's worth thinking about, because in the past, many investors might have looked at covered call ETFs and thought, if I want high income, I have to sacrifice too much growth. But newer products are making that conversation more nuanced. Maybe the question is no longer growth or income. Maybe the better question is, how much growth and income do I want to balance? That's a much better question. And it also explains why funds such as JEPI and JEPQ are often brought into the conversation. These funds are very popular and have helped make covered call investing more accessible to individual investors. But each fund has its own portfolio construction and strategy. One fund may be more defensive. Another may track its underlying index more closely. One may prioritize income. Another may try to retain more upside. There is no perfect choice for everyone. And this is what I want you to remember when you see those big yield numbers on your screen. A large number by itself does not make an investment good. You have to understand the mechanism behind that number. You have to understand what you're giving up to receive it. And most importantly, you have to put it in the context of your own life. If you're building wealth for the next 30 years, you may prioritize one thing. If you're living off your investment portfolio today, you may prioritize something completely different. And perhaps that is the biggest lesson behind the Goldman Sachs and NEOS deal. Wall Street is changing. Investors don't just want their stocks to appreciate. They want their assets to work for them. They want income. They want flexibility. They want cash flow. But at the same time, they don't want to completely give up their potential for growth. And the gap between those two needs is creating one of the most interesting competitions in the ETF market today. Goldman Sachs has entered the game with a new advantage. NEOS brings expertise and products. Competitors such as JP Morgan and other ETF providers will have to continue innovating. And for individual investors, the important thing isn't to pick the winner today. The important thing is to understand how the game is changing. Because once you understand the mechanics, you won't be as easily impressed by a big, attractive yield number. You'll start looking at the entire picture: income, growth, risk, fees, upside, and ultimately, total return. That's how a long-term investor should evaluate an ETF. Not through emotion, not through marketing, but by asking one simple question: after 5, 10, or 20 years, what has this strategy actually done for my wealth?
What's more interesting is the potential for covered call products to retain a meaningful portion of the underlying market's growth while still generating cash flow. If you look at periods when the market rises sharply, you can see why upside matters. An investment might pay you 10% a year, but if the value of the underlying asset declines significantly or grows too slowly, you need to look at the entire picture. On the other hand, an ETF with a lower yield that retains more upside could potentially generate a higher total return over the long term. That's why I always want to come back to one very simple principle. Don't invest in a number, invest in a strategy. And if you're using ETFs to build passive income, make sure you understand exactly what that strategy is doing with your money. A covered call is not magic. It's a tool, and just like any tool, its value depends on how you use it. A retiree who needs reliable cash flow may view it very differently from a 35-year-old investor trying to maximize wealth over the next 30 years. The same ETF, two completely different goals. That's also why I don't think we should look at the Goldman Sachs and NEOS deal simply by asking, should I buy a NEOS ETF or invest in Goldman Sachs? The more interesting question is, why does one of the world's largest investment banks want to make a bigger bet on income investing right now? If the answer is that investor needs are changing, then this is a trend worth watching. A large generation of older investors is entering the stage where they need to turn their accumulated wealth into income. At the same time, a younger generation of investors is becoming increasingly interested in financial independence and passive income, and both groups are creating demand for products that can generate cash flow from investment portfolios. That's the market Goldman Sachs has just decided to make a bigger bet on, and I think this is the part that deserves the most thought. In investing, we often try to find the best investment, but sometimes the better question isn't what is the best investment? It's what investment is best for the life I want to build. If your goal is to grow your wealth, prioritize strategies designed to grow your wealth. If your goal is to generate income, understand exactly how that income is being produced. If your goal is a comfortable retirement, look for the right balance between growth, income, and risk. Don't let the market decide your goals. Let your goals determine how you use the market, and perhaps that's the biggest takeaway I want you to have after watching this video. Goldman Sachs acquiring NEOS for approximately $2.3 billion is a major transaction. But for individual investors, the real value of this story isn't the $2.3 billion figure. It's the bigger trend behind it. Money is shifting from simply accumulating assets toward finding ways to turn those assets into usable cash flow. And in that transition, covered call ETFs may have a role to play. But always remember, yield is part of the story. Total return is the whole story. Understand what you're receiving, understand what you're giving up, and most importantly, make sure your investment strategy serves the life you want to live, not the other way around. Thank you for taking the time to watch. If you invest in income ETFs, covered call ETFs, or you're building a retirement plan around passive income, I'd love to hear your thoughts. Do you prioritize higher yield or higher total return? Let me know in the comments below. And if you found this analysis helpful, be sure to hit like, subscribe, and turn on notifications. We'll continue breaking down the changes taking place in the US market, not just looking at what's happening today, but trying to understand what could happen next. Invest with discipline, be patient, and above all, let your money serve the life you actually want to build.